In the previous episode, I showed you how to analyze the company's balance sheet by looking at the company's assets section and asking 4 key questions about its assets. In today's video, we'll be doing the same thing, but for the liabilities and owner's equity. And so if you haven't seen last week's episode, you can watch it after watching today's video. And so the breakdown of today's video is going to be, I'm going to show you first the questions you should be asking, and then I'm going to show you what support you should be asking for, and then third, I'm going to show you how to analyze that support, and then finally how to arrive at a conclusion based on the information provided. And as a quick example of what I'm talking about, let's say the company has $10 million of debt on the balance sheet, and that sounds like a lot, but the right way to look at this is to compare it to equity and do a debt to equity ratio, and then compare it to other companies in the same industry to figure out if the company is taking too much risk. And if you're new to this channel, welcome. My name is Bill Hanna. I'm the financial controller. I'm a licensed CPA in the great state of New York. And in this channel, we talk about all things related to accounting, finance, fraud cases, financial statement analysis. So if you haven't already, go ahead and subscribe down below. All right, so this is the balance sheet for Crab Cake Inc. And Crab Cake Inc. is in the business of frozen food. So they manufacture frozen crab cake. And this is the balance sheet as of December 31st, 2020. Now, when we look at the liabilities and equity section of the balance sheet, I'm gonna have questions related to accounts payable, deferred revenue, long-term debt, and shareholders' equity. But I'm gonna begin by looking at long-term debt because this is the riskiest area of the balance sheet. When I look at long-term debt, I see the company has $10 million in long-term debt. And the question I'm gonna have is whether the company has too much debt on its books. And what I'm gonna do is the support in this case is gonna be by analyzing the debt to equity ratio. The debt to equity ratio compares the company's total liabilities to its shareholders' equity, and it can be used to evaluate how much leverage the company is using. Higher leverage ratios tend to indicate a company or a stock is taking too much risk to shareholders. And although the calculation for debt to equity ratio takes into account total liabilities divided by shareholders' equity, for the purpose of this video, we're going to modify the debt to equity ratio to focus on long-term debt only because the risk associated with long-term debt are different than short-term debt and payables. And so this means the way to validate is to calculate the debt to equity ratio, and the calculation will go like this. We'll take long-term debt, in this case long-term debt is $10 million, and we'll divide that by $5.2 million, which is the amount of shareholders' equity, and that will give us a factor of 1.9. Now, we'll take that 1.9 factor and we're gonna benchmark it against companies in the same industry. So as we said, this company Crab Cake Inc. is in the frozen food manufacturing. So we'll go to Ready Ratios. This is a website that I use a lot to get benchmark in industry to figure out whether I'm in line with the other companies in the same industry. So if we look up the food and Kinder products, which is in the same category as Crab Cake Inc., we'll find that the debt ratio, or here debt to equity ratio, typically is less than 1, right? So if we go back, we'll find that ours is 1.9, which may indicate that we have way too much leverage in the business by taking on too much long-term debt. All right, so my conclusion based on this analysis is gonna be that this company here is using 1.9x more debt than stock issuance to finance its business. And this could be a sign of too much leverage, but it might be okay if they are, for example, taking advantage of a low interest rate environment. So how am I doing so far? I hope that you're learning tons and tons from this. And if you like this work, I think you're going to love my online courses in financial analysis. I'm going to leave links down below in the description, so go ahead and check it out. And now let's get back to it. Okay, so the next area of risk is going to be in the short-term liabilities or current liabilities. And we'll look first at accounts payable. And the balance that Crab Cake Inc. has as of December 31st, 2020 is $7.5 million. And the question I'm going to have on this is going to be, do we owe suppliers longer than 90 days? If we owe suppliers longer than 90 days, this may signal that the business is unable to meet its current obligations. And so the support I'm going to look for here is going to be accounts payable aging, and that's going to show me the breakdown of the $7.5 million by supplier and by time period. So I'm going to be able to see the duration, 30 days, 60 days, 90 days plus, and figure out which invoices or which vendors are overdue. And so I'm going to take that accounts payable aging and I'm going to look at it and check for large aged supplier invoices. And the conclusion I'm going to have out of this is going to be like, if there are large invoices aged longer than 90 days, there is a good chance that the company is either mismanaging its cash flow or having real operational issues. All right, the next account I'm going to have a question on is a fun account, and that's deferred revenue. And the company has a balance of $500,000 at year end. And deferred revenue, and also is referred to as unearned revenue. This is the balance that represents the cash that you receive from customer for a product or service that you are yet to deliver. You haven't delivered the good or the service. And so the $500K in deferred revenue is going to turn into revenue, but in the future, right? As the company delivers its good and service in the future, that deferred revenue balance is going to turn into actual revenue, but in the future. And you don't want to be counting future revenue as today's revenue, because the last company that did that was a company in the 90s and began with letter E. Enron, you guessed it, you don't want to be that guy. All right, so then the question I have on this balance of $500,000 is going to be, are we expected to deliver on these goods or services? And the support I'm going to be asking for is as follows. I'm going to ask to see a breakdown by customer and by product of this balance, right? So I want to make sure that I can deliver on these products. And the way it's going to be is that when I look at it, I'm going to check and inquire with management whether the company has the capability to deliver a product or service that is listed on this balance here, $500,000. And as a conclusion to my question and analysis, if the company cannot deliver the product or service, there might be a chance that we're going to end up paying this back to the customer if we are indeed unable to deliver the good or the service. So are you still watching? If you are, thank you so much for sticking around. And if you haven't already, go ahead and tap that like button below so we can spread this video around and it can reach someone who may need to watch it. Now, my fourth and final question is going to be related to shareholders' equity. And the company has a balance of $5.2 million. And my question is going to be, have the owners invested enough of their own capital in the business? Because obviously when the owners invest their own money in the business, you know that they have good faith in the business. So my support, what I'm going to need to see here is going to be the cap table, or the table summarizing the capital of the company to see who is invested in the company. And I'm going to look at that and I'm going to see, okay, does the equity include contributions from the founders and the owners of the company? And my conclusion by looking at that is going to be that it's a strong bullish sign on the business itself to see that the owners are investing their own money in the company. And the opposite is also true. If you see that they're not investing in the business, it means that they have little faith in the company. And that's how you can tell whether the owners have enough faith in their own company for you to invest in it. And this template here can be downloaded on Patreon along with all of the templates that I use on my videos. If you become a supporter on Patreon, I'll leave a link down below for the website. Thank you so much for your support. That's it for today's video. If you learned something new from it, please give it a big thumbs up and I'll see you in the next video.